March 15th, 2008. Bear Stearns just collapsed. I'm on the phone with my team at 3 in the morning, and I'm not panicking. I'm buying. More specifically, I'm building the largest short position of my career while every other hedge fund manager on Wall Street is throwing up in their trash can. 16 hours later, I'm up $260 million in a single day. Why am I telling you this story? Because that exact setup is happening again, right now. February 2026, the pieces are in place, the trap is set, and 95% of investors have absolutely no idea what's about to hit them. I'm Stanley Druckenmiller. I've been doing this for 40 years. I made George Soros $1 billion in one day shorting the British pound. I've survived and profited through 6 major market crashes. And I'm going to show you exactly why the next 9 months will be the most dangerous period in modern financial history, and more importantly, how a small group of prepared investors will make generational wealth while everyone else loses everything. By the end of this video, you'll know the 3 specific signals that tell you when the crash begins. You'll see my actual portfolio allocation right now, the exact percentages, and I'll walk you through my month-by-month playbook for the rest of 2026. But first, you need to understand something that nobody in finance is talking about. The liquidity crisis has already started. You just don't see it yet. Let me show you what I mean. Picture this. It's 1999. I'm sitting in my office watching the NASDAQ explode higher. Every tech stock with .com in its name is going parabolic. My analysts are showing me companies with zero revenue trading at billion-dollar valuations. And everyone is telling me I'm an idiot for not being fully invested. I'll never forget this conversation. One of my portfolio managers comes into my office. Smart guy, Ivy League, 10 years experience. He says, "Stanley, we're missing it. We need to be in these tech stocks. The fundamentals don't matter anymore. It's a new paradigm." You know what I told him? I said, "Get out of my office. And if you use the words new paradigm again, you're fired." Why? Because I've seen this movie before. In the late 80s, Japanese real estate was the new paradigm. In the early 90s, emerging markets were the new paradigm. Every single time, it ends the same way. Total collapse. The fundamentals always matter. Always. So I stayed out. I watched everyone else make money for another year. They called me washed up, out of touch, too old to understand the internet. And March 2000 hit. The NASDAQ crashed 78% over the next 2 years. Those geniuses who understood the new paradigm, bankrupt. Every single one of them. But here's what keeps me up at night. The setup today is worse than 1999, worse than 2007, worse than any period I've seen in 40 years. And I'm going to prove it to you with simple math that a 10-year-old could understand. The Federal Reserve's balance sheet in 2008, right before the financial crisis, was $870 billion. That's what they had to work with to save the system. Total U.S. government debt at that time was $10 trillion. Fast forward to today, the Fed's balance sheet is $7 trillion. Sounds like a lot, right? But U.S. government debt is now $38 trillion. Let me say that again, $38 trillion. Here's where it gets insane. The interest payment on that debt, just the interest, not paying down the principal, just the interest, is now $1.1 trillion per year. The United States government spends more money on interest payments than it spends on defense, more than the entire military budget, just paying interest on money we already borrowed. Do you understand what this means? Every single dollar the government spends on interest is a dollar that doesn't go to infrastructure, education, healthcare, anything productive. It's just gone. Poof, into the pockets of bondholders. And here's the kicker. That $1.1 trillion is calculated at an average interest rate of around 3,205% across all U.S. debt. But new debt is being issued at 5% or higher. As old bonds mature and get refinanced at higher rates, that interest payment is going to explode. 2 trillion, 3 trillion. It becomes a death spiral. This is not political. This is not partisan. This is simple arithmetic. And the arithmetic says the system is broken. Now, you might be thinking, okay, Stanley, the debt is high, but the economy seems fine. The stock market is near all-time highs. Unemployment is low. Why should I be worried? Let me tell you a story that will answer that question. 1992, I'm managing money for George Soros. We're looking at the British pound. The United Kingdom is trying to maintain a fixed exchange rate with the German Deutschmark, but their economy is weak. Inflation is rising. And the Bank of England is running out of foreign currency reserves to defend the pound. Everyone thinks the UK government will never let the pound break. They'll do whatever it takes, people said. The credibility of the nation is at stake. We did the math, we ran the numbers, and we realized something simple. The Bank of England didn't have enough money to defend the pound against a sustained attack, so we shorted it massively. We put billions of dollars on the line, betting the pound would collapse. September 16th, 1992, Black Wednesday, the pound crashed. The UK was forced to exit the European exchange rate mechanism, and we made over $1 billion in a single day. Why am I telling you this? Because the same setup exists today with U.S. Treasury bonds. Everyone assumes the U.S. government will always be able to borrow money cheaply. It's U.S. debt, they say. It's the safest asset in the world. There's no alternative. But I'm looking at the numbers, and the numbers say something very different. International buyers are walking away. China's holdings of U.S. treasuries have dropped from over $1 trillion to under $800 billion. Japan is selling to defend their own currency. OPEC nations are diversifying into other assets. So, who's buying? The U.S. government is selling $2 trillion of new debt this year. If foreigners aren't buying, who is? The answer is U.S. banks, U.S. pension funds, and U.S. money market funds. In other words, the government is borrowing from its own citizens. We're funding our own deficit by pulling money out of the private economy. This is the liquidity trap. Every dollar that goes into treasury bonds is a dollar that's not going into stocks, corporate bonds, real estate, or small business loans. The government is sucking liquidity out of the entire financial system to fund its deficit. And at the exact same time, the Federal Reserve is running quantitative tightening. They're shrinking their balance sheet by $60 billion per month. That's $720 billion per year being removed from the system. Added up, $2 trillion from Treasury borrowing, $720 billion from Fed QT. That's $2.7 trillion of liquidity being drained from the financial system in 2026. Let me put that in perspective. The entire market capitalization of Apple, the largest company in the world, is about $3 trillion. We are removing almost one Apple worth of liquidity from the system this year, and people are wondering why I'm defensive. Now, here's what nobody is telling you. This liquidity drain happens in stages. It doesn't hit all at once. It's like a slow-motion car crash. First, the most vulnerable parts of the market break. Then the cracks spread. Finally, everything collapses at once. Let me walk you through the 3 stages so you know exactly what to watch for. Stage 1, the illusion. This was 2023 through 2024. The Fed raised interest rates to 5.5%. Everyone panicked. This will crash the market, they said. But the market kept going up. The S&P hit new all-time highs. Bitcoin rallied. Everyone was confused. Here's what they missed. While the Fed was raising rates, the Treasury Department was draining the Treasury General Account. That's the government's checking account at the Fed. They drained over $600 billion from that account and injected it directly into the financial system. So you had this bizarre situation where rates were high, but liquidity was abundant. The market looked at the liquidity, not the rates, and went up. This is why I always say, don't fight the Fed. But more importantly, don't fight the Treasury. Stage 2, the squeeze. This is right now. February 2026. The Treasury General Account is empty. There's nothing left to drain. Now the government has to actually borrow money to fund its deficit, and that's when the liquidity drain begins for real. Here's where it gets dangerous. Most investors don't understand what's happening. They see stocks near all-time highs and think everything is fine. But underneath the surface, liquidity is evaporating, trading volumes are declining, bid-ask spreads are widening, small cap stocks are already in a bear market. Nobody's noticing because the headline index is still up. This is exactly what happened in 2007. The cracks started appearing in subprime mortgages in early 2007, but the S&P 500 didn't peak until October. For 9 months, the foundation was crumbling while the roof looked fine. Then the whole house collapsed. We're in that 9-month window right now. Stage 3, the break. This is what I'm predicting for late summer to fall 2026. First, small cracks appear. A regional bank fails. A private equity fund gates redemptions. A corporate bond offering gets pulled because there are no buyers. The financial media calls it isolated incidents. Then the cracks spread. Credit spreads widen. Junk bonds sell off hard. Margin calls trigger forced selling. What was orderly becomes disorderly. Suddenly everyone wants out at the same time, but there are no buyers. Liquidity disappears completely. Finally, the panic. The Fed realizes they broke something. They reverse course. They restart quantitative easing. They cut rates back to zero and immediate FERP release. Crisis this time, nobody believes them. Because they've cried wolf too many times. Because inflation is still elevated. Because the credibility is gone. That's when you get a real crash. 30%, 40%, maybe more, and it happens fast. Not over months, more weeks. Now, I know what you're thinking. Stanley, you've been predicting crashes for years. You're always bearish. What if you're wrong again? Fair question. Let me address it directly. Yes, I've been early before. In 1999, I thought the tech bubble would pop in 2000. It popped in 2001. I was a year early. That cost me money, and it hurt. But you know what? I survived, and when the crash finally came, I was positioned to profit. Being early is not the same as being wrong. Being early means you preserve capital, and you're ready when the turn comes. Being wrong means you blow up, and you're not around to play the next hand. So yes, maybe I'm early again. Maybe this crash doesn't happen until 2027. But I'd much rather be 6 months early and safe than 1 day late and bankrupt. And here's the thing. The cost of being wrong if you're defensive is if I'm sitting in cash earning 5% and the market goes up another 10% this year, I miss out on 5% of gains after accounting for my cash yield. That's annoying, but it's not fatal. But the cost of being wrong if you're fully invested, if you're leveraged, if you're in high-risk assets when the crash hits, that's catastrophic. You lose 30, 40, 50%, and you don't recover for years. Risk management isn't about maximizing gains. It's about surviving to play another day. And right now, survival is more important than gains. So let me show you exactly how I'm positioned. My portfolio right now is brutally simple. I don't have 100 positions. I don't have exotic derivatives. I have 5 buckets. That's it. Bucket 1, cash and treasury bills. 35% of my portfolio. Yes, more than 1/3 is in cash equivalents earning about 5% risk-free. People tell me this is stupid. Cash is trash, they say. You're losing to inflation. You're missing the rally. Here's what they don't understand. Cash is optionality. Cash is power. When everyone else is forced to sell in a panic, I'll have billions in dry powder to buy assets at 20 cents on the dollar. In 2007, I moved heavily to cash. Everyone called me an idiot. Then 2008 happened. I bought when everything was on fire sale. So I made $260 million in 1 year while everyone else was getting wiped out. Cash is not trash. Cash is the most valuable asset in a liquidity crisis. Bucket 2, short positions. 25% of my portfolio is actively betting against the market. What am I shorting? Zombie companies. These are companies with high debt, low cash flow, and business models that only work with cheap money. When rates stay high, they die. Commercial real estate. Office buildings are empty. Remote work destroyed them. But the market hasn't fully priced this in yet. REITs are going to get massacred. Regional banks. They're sitting on massive unrealized losses in commercial real estate loans and mortgage-backed securities. Silicon Valley Bank was just the appetizer. The main course is coming. And here's my biggest short. I have 15% of my portfolio in put options on the QQ, the NASDAQ 100 ETF. Strike price is 10% below current levels. Expiration is September 2026. Why the NASDAQ? Because tech stocks are the most overvalued, most overcrowded, most fragile part of the market. When liquidity drains, they fall first and fall hardest. Bucket 3, gold and precious metals. 20% of my portfolio. But I'm not buying gold bars and burying them in my backyard. I'm buying gold mining stocks. Barrick Gold, Newmont, Agnico Eagle. Why miners? Because they give you leverage. When gold goes up 20%, miners go up 60 to 80%. I'm also in silver. First Majestic, Hecla Mining, Pan American, silver. Silver is more volatile and has industrial uses, so you get dual exposure. Why gold at all? Because when trust in government breaks down, when currencies collapse, when the financial system fractures, gold is the only asset that doesn't require anyone's promise. It's been money for 5,000 years, and it will be money when the dollar isn't. Bucket 4, energy, 10% in oil and gas, ExxonMobil, Chevron, ConocoPhillips, plus uranium exposure through Cameco. Why energy? Because you can't print oil. The Fed can print infinite dollars, but they can't print one barrel of crude. Supply is constrained. Demand is growing. And when inflation comes roaring back, energy stocks will be your best defense. Bucket 5, defensive consumer staples, 10% in the boring stuff. Procter & Gamble, Coca-Cola, Johnson & Johnson. Even in a depression, people brush their teeth. They buy toilet paper. They drink soda. These companies have pricing power, strong cash flow, and dividends that don't get cut. That's it. 5 buckets, 100% allocated. Notice what's missing? No Magnificent 7 tech stocks, no crypto, no meme stocks, no IPOs. None of the garbage Wall Street has been selling for the last 3 years. This is not a portfolio designed to get rich quick. This is a portfolio designed to survive what's coming and then profit massively when assets go on sale. Now let me give you the 3 specific signals that tell you when everything breaks. Signal 1, the 10-year Treasury yield crosses 5% and stays there. Right now the 10-year yield is around 4.3%. If it breaks above 5 and holds for 3 consecutive days, that's your first red alert. Why does this matter? Because 5% means the bond market no longer trusts U.S. government debt. It means investors are demanding a higher risk premium to lend money to the Treasury. That's unprecedented in modern history. When that happens, the government's interest costs explode. They're forced to borrow more just to pay interest on existing debt. It becomes a death spiral, and the Fed loses all control because they can't cut rates without the dollar collapsing. When you see 5%, move immediately. Take another 10% out of risk assets and into gold and cash. Signal 2, the regional bank index crashes 30% from current levels. The KRE ETF tracks regional banks. Right now it trades around $45 per share. If it falls to $31.50 or below, that's a 30% decline, and that means systemic banking crisis. Why? Because regional banks hold most of America's commercial real estate loans. And commercial real estate has declined 40% in value, but it hasn't been marked to market yet. The losses are hidden. When deposits start fleeing and banks are forced to sell assets to meet withdrawals, those hidden losses become real. Then you get bank runs, FDIC interventions, a cascade of failures just like 2008. When KRE hits 3150, go to maximum defense, 50% cash minimum. Signal 3. Credit spreads explode to 6% or higher. Watch the spread between junk bonds and investment-grade bonds. Specifically, watch HYG versus AGG. Right now, the spread is about 3.5%. That's calm. But when it hits 6%, that means the credit market is freezing. Companies can't borrow. Refinancing becomes impossible. Defaults spike. This is what happened right before Bear Stearns and Lehman collapsed. Credit spreads blew out first. Then everything followed. When credit spreads hit 6%, the crash is no longer theoretical. It's here. Move to maximum defensive positioning immediately. Now let me walk you through my exact playbook month by month for the rest of 2026. Phase 1. Right now through summer I stay defensive. 35% cash, 25% short, 20% gold, 10% energy, 10% defensive stocks. I'm watching all three signals like a hawk, and I'm waiting for the catalyst. It could be a bank failure, a corporate default, a foreign debt crisis. I don't know what it will be, but I know it's coming. During this phase, I don't chase. I don't get FOMO. I sit on my cash earning 5% and I wait. Phase 2, summer through fall. When I see two of my three signals trigger, I go maximum aggression on the short side. New allocation, 30% cash, 50% short, 15% gold, 5% energy. Why 50% short? Because this is when you make generational wealth. 2008 made me $260 million because I was massively short when everyone else was desperately long. I'll add shorts in semiconductors, consumer discretionary, home builders, and anything trading above 30 times earnings. Phase 3, late fall through winter. This is the hardest part. You have to recognize when the selling is exhausted and cover your shorts, even when the world feels like it's ending. How do I know when? I watch for Fed action, not their words. When they actually restart QE, not just talk about it, that's your signal the bottom is forming. I'll cover half my shorts and start buying quality companies at 50% discounts. Microsoft at half price, Apple at half price, Google at half price. Phase 4, 2027, the rebuilding phase. The crisis has passed. The Fed has printed trillions. Assets are recovering. I move from defense back to offense. New allocation, 10% cash, 60% stocks, 20% gold, 10% alternatives. This is when you build wealth for the next decade. But you can only do this if you survive the crisis. And survival requires correct positioning before the storm hits. Now I need to tell you about the one mistake that will absolutely destroy you. And I see people making this mistake every single day. The mistake is refusing to change your mind when the evidence changes. I watch billionaires go bankrupt because they couldn't admit they were wrong. I've seen brilliant investors lose everything because they were too stubborn to pivot. In 1998, I was convinced the tech bubble was about to pop. I shorted tech stocks, and I got absolutely killed. I was right about the destination, but wrong about the timing. And in markets, timing is everything. You know what I did? I covered my shorts. I admitted I was early. I stepped aside and I waited. When the bubble finally popped in 2000, I was positioned correctly and I made all my money back and more. The lesson? Don't marry your positions. Markets can stay irrational longer than you can stay solvent. When the facts change, you change your strategy. Right now, the facts say liquidity is draining, rates are staying high, and valuations are insane. So I'm defensive. But if the Fed pivots tomorrow and starts printing $5 trillion, I'll cover my shorts immediately and buy stocks. I don't care about being right. I care about making money. Check your ego or your ego will bankrupt you. Let me tell you why this crisis will be worse than 2008. Every previous crisis had an escape hatch, a way for the Fed to ride to the rescue. 1987, Fed cut rates and flooded liquidity. Crisis over. 2000 dot-com bubble. Fed cut rates from 6 to 1%. Crisis over. 2008, Fed cut to zero and printed $4 trillion. Crisis over. 2020 COVID, Fed printed $5 trillion in 6 months. Crisis over. But this time is different. And I don't say that lightly because this time is different are the four most dangerous words in finance. But this time actually is different. The Fed can't cut rates to zero because inflation is still elevated at 3%. If they cut to zero, inflation will spike back to 8 or 9%. They can't print unlimited money for the same reason. They're trapped. If they keep rates high, they break the economy. If they cut rates and print, they get runaway inflation. There is no good option, only bad and worse. This is why I keep saying this will be the worst crisis since the Great Depression. In every previous crisis, the Fed had unlimited ammunition. This time, they're out of bullets. The playbook that worked for 40 years doesn't work anymore. Look, I know this video is dark. I know it's not what you want to hear when your portfolio is up and everyone around you is making money, but I didn't build a 40-year track record by telling people what they want to hear. I did it by telling them what they need to hear. The liquidity crisis has already started. The math is broken. The trap is set. The only question left is timing. You have a choice right now. You can ignore everything I just said and hope I'm wrong. Or you can take defensive action and position yourself to not just survive, but profit from what's coming. I'm not saying sell everything and hide in a bunker. I'm saying be smart, build cash, hedge your longs, get out of garbage, don't use leverage. When this hits, 95% of investors will lose 30 to 50% of their net worth. But the 5% who position correctly won't just survive. They'll buy assets at fire sale prices and build generational wealth. In 2008, I made $260 million in 1 year, not because I'm smarter than everyone else,